Hey everybody, it's Nick. Just gonna do, it's Monday, January 9th. Just doing a little catch up here with some of the Playbook reviews. This one is from December 5th. It was the first issue of the 912 Financial Group Playbook, and I just wanted to go over the trader trend aspect of it. Now, I'm going to do these a little more promptly going forward. I've just been kind of working out how I want to review these suckers that makes the most sense. And again, the goal being that we're going to catalog all of these things to see how we're doing and also show how simple it is and how execution works. Because the biggest feedback I've been getting talking to other subscribers and people who are thinking about subscribing is that they are hesitant to put on the trades and not execute it because they don't fully understand the playbook itself. And I could understand that. So my goal here is to go over everything and also to clear up any complications or problems people are having with the execution of the playbook, and also to see kind of how it did, right? So again, this is the one that came out on December 5th. This is the trader trend review. I already did review the fourth quarter investor trend in another video on the YouTube site, so you can view that at your convenience. And this one will be all units that are pretty much going to be expiring on the December 16th. Okay, so without further ado, let's get it going. So scrolling down here, I did go over all the market expectations, but the big expectation here in the write-up, if you read it, was to actually not do the trader trend and to do the investor trend recommendations only. But like I've told you before, results vary. You decide how you want to trade and what you want to do. The investor trend is going to be selling deep out of the money puts. You are going to basically outperform and gain alpha as prices drop, because you could hopefully maybe even take ownership of the stock at those prices and accumulate at really good levels. But you will underperform on a big rally. So the flip side is that the trader trend is going to be faster. You'll typically outperform as you go up because you'll be selling calls and shorter dated units, and you should be able to do better with a little faster movement. So that being said, the recommendation in this issue was to stick with the investor trend. But for anybody who did do the trader trend, I just want to go over it, and you can't practice this stuff enough anyways. So the first one was DVN, you can see right here, and that one was to sell the December 60 naked put with a stop at 58.24. As you can see over here, right? We sold the 60, option price was 30 cents. The stock was at 69.75 with the stop obviously right here, 58.24. You got it back, right? Option price closed, you got it back, you bid a nickel, which is a good practice on all these units. And we made $25 on that, right? So if you had executed it, it went out, you made 25 cents per contract that you put on there. Okay, moving on. We covered BABA as a investor trend, so I'll just move down here. So HYG, we had now remember, again, going over this stuff, all you really have to do if you're executing the trade maintenance suggestions is sell the put, right? But you sell the put with the idea of the conditional stop loss is always going to be in there. So let's say price opens wherever, as long as it's not underneath the stop, right? And you sell the naked put. Now the conditional entry, right? The conditional entry is the bull call spread, which is going to make, if you have a short put and you have a long call, right, which is half the bull call spread here, that's going to be a synthetic stock, right? And then you're selling the call, right? So the 79 call you're selling is going to be basically making a synthetic covered call. So anyway, that's I just want to say that this is optional, right? If you don't want to be really aggressively long here, don't do the bull call spread, just sell the put. All right, sell the put with the stop. That's it, and see how it plays out. Okay, so let's see what happened here. I did cover everything just in case you did actually do the bull call spread as well. So price opened at 75.28. The option was worth $1.04 if you had sold it for the 75.50 put. It got stopped out because it was so close, right? It opened at 75.28 and the stop was 74.80. So, good practice on this too, you guys. If it opens really close to the stop, just let it trade through the entry and, take it as jump in that sucker as a stop order, right? But if it gets really close, then it's your risk. Now, the good thing was if you did take it, you only lost $6. Now, because the conditional entry was if price was under was 75.90 or below, well, you automatically would take it right when it opened. If you had have been doing that, but again, best practice is to let price trade back up and prove itself, so you don't get stopped out. But if you had taken it, you got stopped pretty much immediately for a 20-cent loss. All right, so going on to TLT, the 109 naked put was the sale with a stop under 105.40. So if you had done it, you would have got it for 380. Now again, look, this thing opened at 105.84. Stop loss was 105.40, a 44-cent stop. You're probably going to get stopped out. Now, if you don't, great, good for you. You just made 375, but odds of that happening are not that good. So give it a little bit of breathing room, let it trade back up, and then, who knows what happened. You may have never got filled, but it got filled. If you did a letter to law, they lost $25. The bull call spread also got filled and stopped out for $5. Okay, so going back, LQD, the goal here was, the recommendation was to sell the 109. And price opened at 108.71 with a stop at 107.02. This one, because you had some room, it worked, right? You got it back for 5 cents. You made $125 per contract. Now the bull call spread also did fill, and you closed it out on expiration for an $81 loss, so it didn't actually make it to its target. Okay, continuing on. EFA. So EFA, recommendation here was to sell the 65. 65 was going for 35 cents. Its price was at 67.49. With a stop at 63.08. So you can see right now you got that back for 5 cents, and you made $30 on that if you had have done it. There was no entry on the actual bull put spread here. The conditional entry didn't get met. So moving on to EWW. EWW, the recommendation was to sell the 51 naked put with a stop at 49.51. Price opened at 52.35. You sold it for 75 cents, and you got stopped out on that. Price went to the actual stop loss target or stop loss point of 49.51, and you took a $75 loss. If you had have done the bull put spread here, then you also would have gotten stopped. If you had have done that, it executed and stopped out for a $100 loss, hitting its stops in the full fill. So moving on to EWZ. EWZ, the recommendation was to sell the 31.50 naked put with a stop at 31.02. Price opened at 30.83, so there was no fill, there was no trade. Going down to gold. GLD, the recommendation was to sell the 163 with a stop at 161.49. If you had it price opened at 166.55, you got the option for 51 cents, and it did go out for 5 cents, netting you 46 cents. Going over here, there was no entry. The conditional order for the bull call spread never filled. Going to SLV. SLV is kind of something I want to go over too. The recommendation was to sell the 1950 put if it opened at 20.91, you guys, so it sold for 7 cents, and you're bidding it back for 5, so it's $2. Don't do that. All right, that's just a waste. If you're not getting at least 15 cents credit, then it's just kind of not worth going for it. All right, and also the bull call spread never got filled. Okay, so going to XME. XME, the recommendation was to sell the 51 put. With a stop at 49.29, price open at 50.75. You got 70 cents for the unit. It did get stopped at 49.29 for $105 loss. $1.05 you're taking on that. The bull call spread also got filled and stopped for another $145. Moving on, XOP. XOP recommendation was to sell the 149 naked put. That one opened, and also with a stop at 143.41. Price opened at 148.96. You got filled for 465. That's where it got filled for. It went right to the stop as well. I think that same day, yeah, for $320 loss, and also the bull put spread. Now remember, if we do bull call spread. I'll cover something else later. Sorry. That also got filled and stopped for a $205 loss. XLE. The recommendation here was to sell the 87.50 naked put. When price opened at 91.20, you got 76 cents for it, and that one 83.96. Oh, it actually opened right at, 91.02. It did get stopped out. Oh, I didn't write that down. But anyway, the bull put spread got stopped out too. So 395 plus. I didn't write down what we lost here, but we lost whatever the max was. Whatever, I could do the math real quick, but those both got knocked out. All right, going on DBA. And okay, well, never mind. We'll go into something later. I've covered it before on just the reason we do bull call spreads versus bull put spreads is just it has to do with dividend. That's all I just wanted to say, but my eyes drifted to somewhere else. Now for DBA, the recommendation was to sell the December 20 naked call with a stop at 2021. Price opened at 19.89. And you got 20 cents for the unit, which would qualify for the $15 I talked about before, which happened, right? You basically just took that $15 off the table. Going to VNQ. Well, I'm sorry, I skipped XBI. Go to XBI. So XBI, the recommendation here was to sell the 84.50 naked put with a stop at 82.26. Price opened at 85.39. You sold the 84.50 for $1.98. Price did get stopped out on that, and the bull call spread filled as well. Price also got stopped there too for $108 loss. And I don't know why I didn't put the total loss on that one, but again, you can figure it out. VNQ, the recommendation was to sell the December 88 naked call with a stop at 87.83. Price opened right at 87.37, and you sold it for $1.31. Sold that call on the 13th of December. Price actually did stop you out, but it stopped you out for a profit here, so $29 profit because of theta decay. So going to XHB, the recommendation was to sell the 61.50 naked put with a stop at 60.06. Price opened at 61.80, and you sold it for $1.05. Price did actually hit the stop loss, and you took a $90 loss. Now, the recommendation for the bull call spread on the trader trend was if price traded down, or basically price was below 61.87 with a stop at 60.06, you took that 61.50, 67 bull call spread. Price opened under this price. So you would have got filled on that, and got stopped out subsequently, it looks like on the same day, for $77. Going to SPY. SPY, the recommendation was to sell the 402 put with a stop at 392.60. Price opened at 403.95. You got a $6.20 credit for that. Price got stopped out at $13.10. You had a $1,690 loss on that. And the bull call spread, the bull put spread, again, because the dividend was coming up, did get filled because price dropped below, or was below 402.74. It hit the stop for a $77 loss. A bigger loss, $300 loss. The Qs, QQQ, you sold the 299 put with a stop at 289.55. Price opened, again, it's one of the ones, you guys, look, it's price opened at 290.38, right? And the stop was at 289.55. So that's expecting that the Qs are not going to drop down 83 cents. Well, they did, but you got a huge credit for it, but they dropped. You got stopped out right away for $60. And same thing on that bull put spread. You got filled right away, and then you got stopped just as quick for $60. So again, let price play out, especially if you're taking these things and it's kind of against the recommendation. But if you're mechanical about it, you're just gonna have to kind of swallow these if you just want to stick with the letter of the law, or just be smart. Let it play back through the entry. It'll give you a little bit better chance of success. And last but not least, you have the Russell. The recommendation here was to sell the 186 with a stop below 181.71. Price opened right at 186.86. You took 345 in credit for that. Price did stop you out at 650. So if you took a $305 loss on that, the bull put spread got filled and stopped for 250. So again, Trader Trend didn't do great. It wasn't recommended to do, but that's why I was saying that you got to really read the report and make your own decision. Results do vary on this. This gives you a lot of discretion, but also an extremely robust risk management system in itself. And you guys, you could test these things. I've tested them going all the way back. They are profitable. They work. But understand the regime you're in. Be smart. You can see how many of these entries you could have just stayed out because they were so close to the stop already. So common sense goes a long way with these things. But I'll keep on going over these. Please feel free to follow me. Add any kind of input. Thank you for the people that have already given me feedback. I'm getting better and better at doing this, and it'll get faster and smoother. Again, if any recommendations, feel free to email me or, follow me on Twitter for more of this information. Thanks, guys.